Every country on Earth is in debt. The United States now owes over $38 trillion, the highest figure in its history. The European Union carries around 14 trillion. Japan, almost 10 trillion. Even oil-rich nations like Saudi Arabia or export powerhouses like Germany and China all owe enormous sums. But here's the paradox. If everybody owes money, who exactly is owed all of it? This is Hidden Wealth Histories, where money, power, and history collide, and nothing is ever as simple as it looks. The world is drowning in what looks like an impossible sea of red ink. As of late 2025, the total amount of money that governments around the world have borrowed has ballooned to a staggering, almost incomprehensible number, over $111 trillion. This leads to a question that seems to defy basic logic. If every country on Earth owes an astronomical amount of money, who exactly holds all that money? If every nation is a borrower, who is the lender? The answer, as it turns out, is hiding in plain sight. It's far more complex, and frankly, far more interesting than any conspiracy theory. The journey to find the world's creditors is not a journey to a single hidden vault, but an investigation into the very plumbing of our global financial system. By the end of this video, you will understand the three main groups that own the world's wealth. The answer will reframe how you think about national debt, and you'll discover that the world's biggest creditor might be much closer than you think. When we try to unravel this mystery, our minds look for a simple answer, a single culprit. And for the last decade, one country has been held up as the world's de facto banker, China. The narrative is powerful. You've heard it on the news, from politicians, and in countless online debates. The idea is that the United States has mortgaged its future to its biggest economic rival. The fear is that if China ever decided to call in the debt, it could trigger an economic collapse in America. This is a compelling story, but it's also the simple, wrong answer. Let's bust this myth right here, using the United States national debt as our case study. The total debt is an eye-watering figure, recently surpassing $38 trillion. Of that, a portion is debt held by the public, money the government borrowed from investors. This is the debt we're interested in. So, how much does China actually own? As of mid-2025, China's holdings of U.S. debt stood at around $759 billion. Now that's an enormous amount of money, but when you compare it to the total U.S. debt of over $38 trillion, it accounts for only about 2%. Just 2%. China isn't even the biggest foreign player anymore. As of 2025, Japan is the largest foreign holder of U.S. debt, with over $1.1 trillion. The United Kingdom has also overtaken China, holding nearly $780 billion. After that comes a list of countries you might not expect: the Cayman Islands, Canada, Belgium, and Luxembourg. Together, all foreign countries and investors combined own about $9 trillion of U.S. debt. That's a significant chunk, about a quarter of the debt held by the public. But it immediately dismantles the idea that one country holds all the cards. The narrative of China as the sole, dominant creditor is simply not supported by the data. Its share has been steadily decreasing for years. So why does this misconception persist? It's politically convenient. It frames a complex issue as a simple story of us versus them. But the reality is where the true understanding lies. The fact that all foreign investors combined hold about 25% forces us to ask a much more interesting question. Where is the other 75%? Who owns the vast majority of the world's biggest pile of debt? To answer that, our first stop is not in a foreign capital. It's much closer to home. In fact, our first creditor is found by looking in the mirror. When a government needs to borrow money, it issues something called a government bond. A bond is just a fancy IOU. It's a certificate that says, you, the investor, have lent the government money. In return, the government promises to pay you back the full amount on a future date, and along the way, it will pay you regular interest. These bonds, known in the U.S. as treasury securities, are sold at auction, and the crucial question is, who is buying them? The first, and by far the largest, group of creditors is the country's own domestic population and institutions. Let's break down who this domestic category includes. First, there are individuals, regular people like you and me. Through savings bonds or brokerage accounts, citizens can lend money to their own government. It's considered one of the safest investments on the planet. When you buy a U.S. Treasury bond, your loan is backed by the full faith and credit of the U.S. government. The consensus is that the risk of the U.S. government defaulting on debt to its own citizens is, for all practical purposes, zero. But individuals are just the tip of the iceberg. The real heavyweight lenders are large institutions. The biggest players here are pension funds. Their job is to grow the retirement contributions of millions of workers safely. They can't gamble with that money. They need a bedrock investment that is incredibly safe and provides predictable income. Government bonds are the perfect solution. So, if you have a pension, your retirement fund is very likely a major creditor to your own government. Your retirement security is literally built on a foundation of government debt. Next are insurance companies. They collect premiums and need to invest that massive pool of cash, the float, so they can pay out claims. Like pension funds, they prioritize safety. So they too are massive buyers of government bonds. Then we have commercial banks, which are required to hold a certain amount of highly safe assets. And finally, mutual funds and ETFs designed to invest in government debt. In the U.S., mutual funds are one of the single largest domestic holders of the national debt. When you add all of these domestic creditors together, individuals, pension funds, insurance companies, banks, and mutual funds, they own an enormous portion of the national debt. In the United States, domestic investors hold over 2/3 of the public debt. U.S. private investors and entities alone hold over $15 trillion, making them the largest single block of creditors by far. This reveals the first part of our paradoxical answer. When we ask who the government is in debt to, the primary answer is us. It's the collected savings of its own citizens, channeled through the massive financial institutions that form the backbone of the economy. This isn't just an American phenomenon. In Japan, which has one of the highest debt to GDP ratios of any major economy, at over 212%, over 90% of its government debt is owned by its own domestic investors. This is often why Japan isn't in the headlines for being on the brink of crisis, despite staggering numbers. Because it primarily owes the money to itself, it's not vulnerable to the whims of foreign creditors. This brings us to a crucial reframing. A large portion of national debt isn't like a credit card bill. It's more like a series of promises a country has made to its own future, to its retirees, its insurance policyholders, and its savers. It's a transfer of wealth from taxpayers to bondholders, who are often the very same people. So we've solved a huge piece of the puzzle. The biggest creditor is domestic. But that still leaves the portion owned by foreigners, which, in the case of the U.S., is around $9 trillion. Why would other countries lend so much money to a nation already so deep in debt? That takes us to our second major creditor. We've established that the idea of a single foreign country owning America is a myth, but that doesn't mean foreign ownership is insignificant. About a quarter of America's public debt is held by other countries, foreign companies, and international investors. This creates a complex web of global financial interdependence. So, Why do foreign entities buy so much U.S. government debt? It comes down to three powerful factors: safety, liquidity, and the role of the U.S. dollar. First is safety. U.S. Treasury securities are widely considered the safest financial asset on the planet. They are backed by the full faith and credit of the U.S. government, which has never had a major default on its principal. For a foreign government or a large corporation, there is simply no safer place to park billions of dollars. Second is liquidity. The market for U.S. Treasury bonds is the deepest in the world. You can buy or sell enormous quantities at any time without dramatically affecting the price. If a central bank suddenly needs cash, it can sell its U.S. bonds in an instant. The third, and perhaps most important reason, is the special status of the U.S. dollar as the world's primary reserve currency. International trade, oil from Saudi Arabia, copper from Chile, is almost always priced and settled in U.S. dollars. Because of this, every country needs to hold a large stash of U.S. dollars. But holding cash is inefficient. It earns no interest. So, they invest those dollars in the safest, most liquid dollar-denominated asset available: U.S. Treasury bonds. Buying U.S. debt isn't just an investment. It's a fundamental part of managing a country's integration into the global economy. Export-heavy countries like Japan and China accumulate huge surpluses of dollars and recycle them by buying U.S. bonds. This gives them a safe place for their earnings and helps keep the dollar strong relative to their currency, making their exports cheaper. This creates a symbiotic relationship. It's not a simple case of a creditor having power over a debtor. If China were to suddenly dump all its U.S. debt, it would cause chaos, but it would also be an act of massive self-harm. The value of their remaining dollar assets would plummet, and the ensuing global turmoil would devastate demand for Chinese exports. No creditor wants to bankrupt their biggest borrower. This global marketplace also explains some of the curious names on the list of foreign creditors. Financial hubs like the Cayman Islands and Luxembourg hold hundreds of billions in U.S. debt, not because they are incredibly wealthy, but because they are centers for international finance, where multinational corporations route their investments. For the United States, this global demand for its debt confers an exorbitant privilege. It can borrow vast sums at much lower interest rates than other countries could dream of. However, this system isn't universal. Many developing nations can't just sell bonds to private investors. They must turn to a different set of creditors: large, multilateral institutions like the International Monetary Fund, IMF, and the World Bank. These organizations act as lenders of last resort, but their loans often come with painful economic reforms. So, we've uncovered two of the three major creditor groups. The first is domestic. The second is foreign. Together, they account for a huge portion of all government debt. But we've saved the most surprising and powerful creditor for last. We've peeled back the first two layers of this global debt mystery. But the biggest and most paradoxical creditor is still hiding in plain sight. Before we reveal who that is, if you're finding this breakdown useful for making sense of the complex world of economics, take a moment to hit that subscribe button. Our goal is to untangle these big, confusing topics, and your support makes that possible. We've accounted for the debt owned by the public, both domestic and foreign. But there's another massive slice of the pie. In the United States, it's a category of debt known as intragovernmental holdings, and debt held by the Federal Reserve. This is where the story gets truly mind-bending. Let's start with intragovernmental debt. This accounts for about $7 trillion of the U.S. national debt. It's basically money that one part of the government owes to another. The biggest component is the Social Security trust funds, which have collected more in taxes than they've paid out. By law, that surplus is invested in special U.S. Treasury bonds. The government has essentially borrowed the Social Security surplus to pay for other spending, leaving an IOU in the trust fund's filing cabinet. But the true secret creditor is the most powerful financial institution in the world, the central bank. In the United States, this is the Federal Reserve, or the Fed. And the Fed is one of the single largest holders of U.S. national debt, holding trillions of dollars worth of U.S. Treasury securities on its balance sheet. This immediately triggers a logical alarm bell. How can an entity that is essentially part of the government be a primary creditor to the government? Isn't that like taking a loan from your left pocket to pay your right pocket? The answer is yes and no. And the difference is everything. Here's how it works in a process often called quantitative easing, or QE. The U.S. Treasury issues new bonds to borrow money. These are sold on the open market. Then the Federal Reserve steps in. The Fed is technically independent of the Treasury, with a mandate to maintain stable prices and maximize employment. To do this, it has a powerful tool. It can create money out of thin air. The Fed goes into the open market and, using this newly created digital money, buys up those government bonds from banks. The net result is that the government has been funded by newly created money. It's the modern, sophisticated equivalent of a king stamping more gold coins. So why do they do this? The official purpose of QE is to influence the economy during a crisis. After 2008 and during the 2020 pandemic, with interest rates already near zero, central banks needed a bigger hammer. By buying trillions in bonds, they pushed down borrowing costs across the economy, intending to spur spending and investment. It also flooded the banking system with cash and acted as a powerful signal that the central bank would prevent a complete meltdown. Most economists agree it helped pull the world back from the brink. But this power comes with enormous risks. The most obvious is inflation. Too much money chasing too few goods. We saw this in the years following the massive stimulus of 2020 and 2021. Another risk is asset bubbles in stocks, real estate, and crypto, which can pop when interest rates eventually rise. And perhaps most insidiously, it creates a moral hazard for governments. Knowing the central bank can print money to buy its debt removes a key element of fiscal discipline, making it easier to run massive deficits. This dynamic isn't unique to the US. The Bank of Japan has taken this to an extreme, at times owning over half of all outstanding Japanese government bonds. Central banks have become, without a doubt, one of the most dominant holders of sovereign debt in the world. So, when we ask who the creditor is, the most shocking answer is this. A significant portion of the debt is held by an entity that can create the very money needed to buy it. It's a circular system of the government borrowing from its own central bank, which blurs the line between borrower and lender. We've now assembled the three main pieces of our puzzle. The answer to who owns the debt is a three-part coalition. Domestic creditors, a country's own citizens and institutions, pension funds, banks, and insurance companies. This is money a country owes to itself. Foreign creditors, a diverse group of other countries and international investors who buy the debt for its safety and liquidity. This is money a country owes to the rest of the world. The central bank, a country's own monetary authority, which creates new money to buy its government's debt, in a sense, owing money to a version of itself that can print money. This three-part structure is the fundamental model for most major developed economies. However, the story is different for many developing nations. They often lack deep domestic financial markets, and their bonds are seen as much riskier. When they need to borrow, especially in US dollars, they often turn to a different set of powerful creditors, multilateral financial institutions. The two most famous are the International Monetary Fund, IMF, and the World Bank. When a country is in crisis, it can turn to the IMF for a bailout. However, these are not friendly loans. They come with significant strings attached, a policy known as conditionality. In exchange for the lifeline, the country must implement often painful reforms, cutting spending, raising taxes, or privatizing industries. For an entire generation, bailout can become another word for sacrifice. In recent years, this landscape has been further complicated by the rise of new state-level creditors. China, through its Belt and Road Initiative, has become one of the largest single lenders to developing countries, raising concerns about transparency and what some critics call debt trap diplomacy. These different layers of creditorship show that there is no single answer. The question of who is the creditor depends on which country you are talking about. For Japan, the answer is overwhelmingly itself. For the United States, it's a mix of itself, the rest of the world, and its own central bank. And for a struggling developing nation, the answer might be the IMF, the World Bank, or the state of China. So, let's return to the paradox. If every country on Earth is in debt, who holds all the money? The mystery isn't that the money is held by a single, secret entity. The reality is that the global financial system is a vast, interconnected network of IOUs. The creditor isn't one person or one country. It is an overlapping web of many actors. We've discovered that the biggest creditor is often the country itself, owing money to its own future retirees and savers. The second creditor is the rest of the world, creating a system of financial symbiosis. And the third, most enigmatic creditor is the modern central bank, an institution with the power to create money from nothing, blurring the very lines between debtor and creditor. The simple question, who did they borrow it from, has a complex, multi-layered, and deeply revealing answer. The world's wealth isn't hiding in a single vault. It's circulating constantly within this system. A system that includes your pension, your insurance policy, the bank on your corner, and the very institutions charged with printing the money we use every day. The paradox of global debt is solved not by finding a single lender, but by understanding that in our modern economy, we are all entangled in the web. We are the borrowers, and in more ways than we ever imagined, we are also the creditors. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.